If inflation has been making your wallet feel lighter lately, you're not imagining it. The latest US inflation report is out, and the headline number came in hotter than expected. Consumer inflation has climbed to 3.8%. Gas prices are surging. Groceries are getting more expensive. Housing costs remain stubborn. But here's the real question: is inflation actually making a comeback, or is this just a temporary energy shock? Let's break it down in layman terms. Let's start with the headline numbers. According to the official U.S. Bureau of Labor Statistics report, Consumer Price Index rose 0.6% in April alone. Year-over-year inflation now stands at 3.8%. Core inflation, which removes food and energy, rose to 2.8%. That's important because core inflation helps us understand whether inflation pressure is spreading deeper into the economy. At first glance, these numbers look worrying. But the real story sits beneath the surface. The biggest reason inflation jumped? Energy. Energy prices rose 17.9% compared to last year. Gasoline alone surged 28.4%. Electricity climbed 6.1%. Fuel oil exploded by over 54%. That's massive. And because fuel impacts transportation, logistics, deliveries, and manufacturing, higher energy prices quickly affect almost everything around us. This was the single biggest driver of the inflation spike. Now let's talk about something every family notices immediately: food prices. Food inflation rose 3.2% over the year. Groceries alone rose 2.9%. Some painful examples: beef prices climbed 2.7% in just 1 month. Fruits and vegetables rose 1.8%. Coffee surged 18.5% over the year. So yes, your grocery bill feeling heavier is absolutely real. Another stubborn inflation problem? Housing. Shelter inflation rose 3.3% year over year. Monthly shelter costs rose 0.6%. Rent increased 0.5%. Owner equivalent rent also rose 0.5%. Why does this matter? Because housing carries one of the biggest weights inside the inflation basket. Even when gas prices cool down, shelter inflation can keep overall inflation elevated. But not everything got worse. Some categories actually cooled. Medical care commodities fell 0.5%. Used vehicle prices dropped 2.7%. New vehicle prices stayed nearly flat. At the same time, airline fares jumped 20.7%. Household furnishings rose 3.9%. Apparel increased 4.2%. So inflation isn't hitting every category equally. Some areas are stabilizing. Others are still heating up. Now the bigger market question: what does this mean for the Federal Reserve? If inflation remains sticky, interest rate cuts may get delayed. That matters because higher rates impact loans, mortgages, credit cards, stock valuations, and overall market sentiment. But here's the nuance: if this inflation surge is mostly energy-driven, policymakers may choose not to overreact immediately. The next few inflation reports will be critical. So what does all this mean for regular people? Higher fuel bills. More expensive groceries. Persistent rent pressure. Potentially higher borrowing costs for longer. For investors, watch inflation trends, energy markets, and Federal Reserve signals very closely. Because one inflation report doesn't define the trend, but it absolutely changes expectations. So now I want your opinion. Is this the beginning of another inflation wave? Or just a temporary energy spike? Which price increase is hitting you hardest right now? Gas? Groceries? Rent? Drop your thoughts in the comments. And if you enjoy simple finance breakdowns like this, hit like button, comment and subscribe for more economic updates made easy at Golden Rule 16.